Hello investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Autodesk. Autodesk just reported their results Q3 2022. Their fiscal year is misaligned with the calendar year, so keep that in mind. The company is aimed at helping designers and manufacturers streamline their process, save money by being able to visualize their data in essence. But the company has been on a kind of a very volatile path, ultimately because they've had to downwards revise their billings guidance for the second time this year. I'm going to go into what that means. We're going to talk about its ability to generate strong free cash flows. Then we're going to talk about its valuation. So here's the thing, right? The stock has been really volatile. If you've owned any growth stocks in 2021, you will have seen this path already. Many of these stocks have kind of come out from early in the summer, they were growing, and then all of a sudden in the past several weeks everything is just kind of pretty much blown away, and investors are just kind of like, oh my god, what's happening right now? And this is interesting because in the backdrop of this, the major indices are all at all-time highs. You look at the S&P, you look at the Nasdaq, they're all just kind of plowing forward. So the guidance, the revenue guidance is strong, okay? So it's pointing towards 22% growth year over year. That's just marginally missing what analysts' consensus, but it's not a big deal, right? The big deal here is if we go back 2 quarters, they were pointing at the back of Q1 2022, they were pointing for billings growth of approximately 21%, okay? So that's the figure. Billings growth for this year was 21%. Then they pointed for in the next quarter, Q2 2022, they pointed for billings growth for approximately at the midpoint 19%. And now, yesterday, they point for the billings growth of midpoint of 15%. So there's been a consistent downwards revision in the billings. What does this mean in practice? Okay, billings is a leading indicator of where revenues will be. The more billings they get booked up front, more cash up front, strong free cash flow generation, revenue gets recognized higher over time. Great. Billings gets downwards revised, that's a problem. But if billings are below the revenue growth rates, that's even a bigger problem. That means the amount of amount of contracts coming in over time is less than revenue growth rate, and that means that its ability to grow rapidly is going to be diminished. So that's really the key thing that I wanted to highlight, okay? So what Autodesk does is a 3D design company helping engineers really figure out problems, okay? So what's particularly attractive right now is that they have this whole prospect of digitalizing the digital transformation and the hand. So there's a lot of opportunity, but in the very near term, they highlighted during the earnings call that they've got supply chain problems right now, labor restrictions, COVID, certain country-specific issues as well, that in the near term there's just how happened to impact them, and they had to downwards revise their billings. So with that in mind, you know, the stock just got utterly demolished and is down 14% in the after hours market. Now, here's the thing to remember. This business makes the guidance for this year is for 33% free cash flow margin. So it's a business that clearly generates a lot of free cash flow, okay? So, and their guidance at the back of the analyst day was for this year to be at approximately 31% operating margins, okay? And they are pointing here that they're going to reach that 31% operating margin. So they're well on the way to going towards the next 2 years reaching 38% operating margins. So with that in mind, I think that investors, you know, will have that to anchor themselves to when things kind of get a bit hairy in the next few days. On the other side of the equation, you have to remember, look elsewhere in the market. In the market right now, there's so many stocks that have just got utterly demolished, and they're expected to grow. So, everyone pretty much would agree they're expected to grow at higher than 30% compounded annual growth rates, yet they're being priced at sometimes just 10 times forward sales. So why would you pay 12 times forward sales for a business that is clearly going to be growing at less than 20% compounded annual growth rate? So with that in mind, I hope that you found this video useful. Don't forget to check out my marketplace called Deep Value Returns. I help you become a better investor. You can check out what other people said about my marketplace in the reviews as well. Okay, thank you so much for listening.